Hello, I'm Justin Soucy, Chief Investment Officer of GNS Capital. We at GNS Capital hope you all had a fun and safe Halloween. It was certainly a cold one here in Colorado. We'd also like to say goodbye to a pretty difficult market environment in October and welcome in the month of November. The purpose of this audio message is to touch base and offer our thoughts on some of the October volatility. Volatility can be quantified in a number of different ways. One way we can quantify it is by how many days the market or the S&P 500 moves up or down in value by 1% or more. For some background, only 8 trading sessions in all of 2017 had a move of 1% or more in either direction. This was actually very unusual and one of the least volatile years on record. In contrast, just the month of October saw more days move up or down by 1% than all of 2017. So I wouldn't necessarily classify October as normal, but a pickup in volatility versus last year was certainly expected. Some possible causes of this volatility that we can address a little bit are rising interest rates, earnings, trade tariffs, and the upcoming elections. No one really knows for sure if these are the reasons for the October sell-off, but let's briefly take a look at each one. When we look at interest rates, the Fed has raised rates 8 times since December of 2015, potentially one more hike in 2018 and a couple more in 2019. As I mentioned in the email we sent out on October 12th, raising the federal funds rate increases borrowing costs for businesses and individuals. It also has a negative impact on the value of bonds. This is one reason we've reduced exposure and shortened the length of bond maturities in your portfolios over the last several months. History would tell us, though, that stocks can increase in value along with interest rates, typically until the 10-year Treasury reaches a 4 to 5% yield. We are just at a little over 3% today. When we look at earnings, so far 77% or so of companies in the S&P 500 that have reported earnings have beat their number, which is higher than the 5-year average of 71%. However, several companies have missed their revenue numbers, and their forward guidance hasn't been quite as rosy as it has been in the past. When we look at trade tariffs, one reason future growth and revenue could be impacted is because of these tariffs. Tariffs are currently at 10% and expected to rise to 25% in January if talks with China don't go well. Lastly, and everyone's favorite topic for the next week or so, is the elections. They're right around the corner, and history tells us that if there's split authority between Democrats and Republicans, typically that is the best for stock markets. The markets may be looking, though, for this event to be over and a little less interested in its outcome. So I'll end with a little bit of an analogy, maybe a car driving analogy. 2017 was a bit like driving with cruise control on. Then at the beginning of 2018, that was a shift to hands on the wheel and maybe tap the brakes a little bit. The further we've come in 2018, I'd categorize it as we've been gently applying the brakes in most of our strategies. We don't necessarily see the need to come to a screeching halt at this point, but we'll continue to evaluate and respond to the market conditions. We're likely to see volatility stay elevated in the near term, but we are entering the seasonally strong period for the markets, so hopefully that will calm things down a bit. Our investment committee is meeting regularly with a few extra meetings in the month of October, and we have a process that can respond to these changing market environments. Reminder as well, if you have friends, family, coworkers who don't have a plan or process for handling what's next in these markets, we would be more than happy to take a look at their situation. And of course, we're always here for you if you have any questions. Please don't hesitate to reach out. Thank you.